Welcome to Investor Copilot. I'm Viraj. Today I'm bringing 4 ETF recommendations which I think are great purchases in this market scenario where the North American markets have peaked or are peaking, and ETFs are a very safe vehicle to park your money in and even to grow it. So let's look at these today. The first ETF is QQC-F. This is offered by Invesco, and it's a US based ETF. The sectors that it invests in and the specific stocks are all US based. So growth is the focus for this ETF. PE ratio, if you focus on, it's on the higher side at 38, which means that this ETF is a little bit overbought, but that's not necessarily a bad sign. NAV is high, it's 145. Now look at the returns. The 1 year return is at 46, which is excellent, I would say. Very aggressive growth plans for this ETF, and 3 year return is also decent at 11%. If you focus on the sectors that it invests in, you can see that technology sector, which is basically all the blue chip technology companies which are fast growing and heavily capitalized, are more than 50% of this ETF. The other sector is consumer, cyclical, and communication services. Again, two very high growth sectors in the US. So obviously the focus of this ETF is to aggressively grow your money, but there is a risk of negative return or lower return as well. So keep this one in mind. Next one we'll talk about is XSP. Now, this ETF is offered by BlackRock iShares. It also focuses on US assets and it's growth focused as well. But it's slightly conservative than the first one because the PE ratio is at 25, which means it is not really overpurchased. NAV is quite low at 54, and the 1 year and 3 year returns are good. So 1 year return at 32% is still very good. And if you see the sector weights here, technology focus is a little less here at 30%, and the other sector that this ETF focuses on is financial services, which are very strong companies in US and safe ones as well. So 12 to 13% in financial services, consumer cyclicals as well, and healthcare is another focus that this ETF brings. So overall, this is safer than the first one that we saw. However, this is also categorized as a growth ETF, and there is a slight chance of negative return, but mostly positive. Now, the third ETF that I want to talk about is ZID. This is offered by BMO. So this is the BMO India focused fund, MSCI India focused fund, and this is a large cap growth fund based out of companies in India. Now, I am recommending this because India, with a growth rate of about 7%, 7.5% currently, is the fastest growing major economy in the world, and it is surpassing China and many other Asian countries as well in terms of growth. A lot of capital is flowing into India, and that's why the capital markets, the stock markets in India are doing well because there is an inflow of capital there, and that is shoring up many good companies. That's why I believe that this ETF is a very safe bet. You have the advantage to invest in Canadian dollars in Indian markets because this is a .to suffix. So the ETF is available on Canadian markets, which is great. PE ratio is great at 19 and NAV is low at 45. 1 year return is at 25%, which means that this ETF plays it safe in the Indian stock markets. And sector weights, if you look at, I believe this is a very good balance here. Financial services, technology, and energy are three core sectors in India which are always growing. Base metals is also a good sector, and that's why I would say this ETF will stay very stable in the long run. So definitely look at this one. And lastly, there is VDY, which is a Vanguard ETF, and it's Canada focused. Now, this ETF almost will definitely give you a positive return, but don't expect growth from it because Although PE ratio is low, this ETF plays it very safe by investing in financial services, that is the banks and energy companies in Canada, which definitely grow but are very conservative and stable businesses, and the growth uptick is very low. So, if you want to set aside some money that you want to be very safe, you don't want to lose a dime there, although there is a chance, slight chance, but still, most of that money will grow at a slow pace but will remain safe. And if you want to take that conservative approach with some part of the money that you have, which you definitely should, VDY is great to look at. So these are the four ETFs that we discussed. Make good decisions. At least 70% of your portfolio should comprise of ETFs at this point of time, and distribute your risks wisely with these four ETFs. Stay informed and look forward to more videos from me regarding some investment tips and some advanced concepts as well. Thank you very much.